Hello and welcome to this special webinar hosted by Renew Economy, sponsored by GridBeyond. Subject today is managing volatility, how AI and batteries can protect energy users. I think many people with an interest in the energy markets have witnessed the rapid changes that have come onto the Australian market, in fact, most global markets over the last couple of years. New technologies have created sort of fundamental changes. We are seeing, it's always been a volatile market. We are seeing more volatility now, both from the supply side and the demand side. We're seeing complex machines enter the market, which has required the need for AI to help manage these systems. We're seeing the rise of battery storage, which has been the most flourishing nature of our energy transition. So to answer that question, we've got a great panel, a lineup of speakers and others to answer your questions. The main focus will be on how do you optimize your energy usage to create the most value for your business while maximizing the benefits of behind the meter assets such as batteries and solar. And so while the emphasis is on business, it's also of interest for households and other people, basically any people with behind the meter batteries and other people just thinking about the way that they're managing their energy costs. We're going to have two presentations and then we're going to have a Q&A. We're going to hear from Chris O'Brien from GridBeyond, Andrew Redaway from NHAR, and then more for the Q&A. We'll also be joined by William Salas from GridBeyond as well. Now, we do like some audience participation, so we'll be throwing a couple of polls out there to get some reaction from you about what you think or what you've experienced. We also invite you to ask questions in the Q&A tab if you can at the bottom of your screen. We do have a chat button there if people just want to get chatty and talk and exchange ideas. But if you do want to have a question answered or at least looked at and possibly asked and answered, then please use the Q&A button at the end. So look, we're going to get a start now with our first presentation, and it's from Chris O'Brien. He's the Managing Director, Australia of GridBeyond. He has more than 16 years experience in the energy sector and has held leadership roles at Edge Zero as Executive General Manager and at SunPower, where he was Vice President of the Asia Pacific and LATAM. So without further ado, I'd just like to welcome Chris O'Brien to this webinar, and the floor is yours, so to speak.
Thanks, Giles. Appreciate the introduction and appreciate all the people that are joining on this webinar. Hopefully you get something out of what we are presenting today. So I'll get straight into it. So what I'm going to cover today is I'm going to start with what AI and data science can do. Just let me move this screen around. Can do for you in the energy space. We'll talk about using AI alongside a digital model of your processes behind the meter and the value that that can create, and take that concept into what we call process optimization. I'll give you a couple of examples of this concept at work, and then I'll touch on battery storage for CNI sites, and Andrew's going to take you through some further benefits in his section. So firstly, the theme of this slide is really the strategic application of AI and data. So the enabling piece is an asset control platform. This is denoted here as the VPP. We know the term virtual power plant typically in Australia as an aggregation platform for assets across multiple sites. In this context, the VPP is a platform that aggregates multiple energy assets across a commercial or industrial site. The VPP is essentially the brain that works with the EMS, and you can see it. This is the point here, the energy management system on site. This could be a SCADA system or a localized control panel. But EMS control can be either as a co-pilot with a human in the loop or as direct site automation where the signal goes directly to site assets. The decision engine the VPP uses is an AI-driven forecast for energy and other market prices that is focused on the NEM in your location. So this allows optimization of any participation in markets, assuring that decisions on which markets to participate in maximizes the value for you. So for those sites with or considering battery storage, optimization from the VPP extends to the decisions related on how to use the energy and capacity of the battery to maximize the value. So these decisions are not only related to where to use the energy, so whether it goes to the grid or to the load, or it becomes available for FCAS. With the power of an accurate forecaster, you can also decide when to use that energy. It may be a decision is not to discharge energy now, as a forecaster can see there's more value in a couple of hours down the track. Clearly, there are constraints around how you operate a battery, around the optimization, and that's related to the warranty constraints that might be from various manufacturers. And these do become key inputs into the VPP platform, ensuring you're optimizing within that envelope. And the final piece of this puzzle, which we're going to talk about, is process optimization. With the platform forecasting and controlling, or providing recommendations to modulate assets based on the markets, we develop a digital twin of your site, modeling energy consuming assets. We then lay that over your 7-day ahead production plan and identify any flexibility in your process. And process optimization then occurs within the asset parameters, your production plan, and the market volatility that creates the opportunity. So the outcome of this is a holistic approach to lower your energy spend and therefore your marginal cost of production. So the theme here, putting together AI price forecasting and a digital twin gives you the maximum benefit. So as an example of our market-leading forecasting accuracy, across Q1 this year in Queensland, GridBeyond's forecast was 17% more accurate overall than the AEMO P5 and 13% more accurate at predicting price spikes. So these improved forecasts really start to translate to substantial value for commercial and industrial sites that use forecasts to avoid high energy prices. So you combine that price forecasting with a digital twin loaded up with your operational parameters, and you can optimize your energy spend without impacting production yields. So the AI creates that optimized energy use schedule to minimize disruption and maximize your savings. And as I mentioned previously, the outcome really that you're looking for is a holistic approach to lower your energy spend and therefore your marginal cost of production. So I'll jump into an example here. And so the path to identifying the value of process optimization starts with reconstructing the load for your 5-minute interval data, typically for the last 12 months. We then lay this over the actual energy prices from the market over that same period and review a site's reaction to the volatility. And just don't be fooled by the scale on this chart. The top prices here on that bottom chart are above $15,000 a megawatt hour. That's why the volatility on the x-axis looks like noise. It's not noise. If we were to zoom in on the lower parts of this chart, you'd see volatility ranging between the tens of dollars per megawatt hour to hundreds of dollars per megawatt hour. And this is really where the day-to-day optimization value occurs. So going back to what is clearly the visible peaks as an example of energy price optimization, we can identify where the missed opportunities are and put savings value on them, assuming curtailment was possible at the time. This is actually a real-world example of a site, and what we're looking at here is $100,000 per megawatt during a peak pricing period over that time between January 23 and July 24. So what we're talking about is a handful of hours, typically 10 to 15 hours over a year, where the modulation of your energy downwards could deliver tens or hundreds of thousands of dollars in savings. And what we're going to see moving forward as we transition away from the traditional baseload generators, we're going to see more and more volatility in the market. So this is going to create an even greater opportunity to capture value within that volatility. So really just looking at how it works, right? So once we've done a backcast to determine the value, we really we're validating the high level business case. We move into modeling the process behind the meter. And this is the process of building the digital twin. And you can see here a reminder of the definition of a digital twin. It replicates your production process and models assets and production schedules in real time. So the forecasting predicts the peak prices. The digital twin simulates constraints and outputs and creates an optimized run schedule. And this can be done as a co-pilot, as I said before, providing signals to your operators, or through an fully automated solution. And you can see the results here on the right-hand side, where you've got essentially smart load shifting. So you can see a base energy load or energy demand. And what we've done is looked at the forecaster, and the forecaster is showing we can actually run our plant faster than we would normally in a base case to get ahead of the production schedule and allow us to modulate our energy demand down during these peak times. So turning it down in response to the high prices. And this is creating the value in your daily production schedule. So a little bit about us at GridBeyond. Our company originated from Dublin in Ireland and is now active in the major deregulated energy markets globally. We're in the US, the UK, Japan, and we've been in Australia for a couple of years now. We've got a foundation of strategic investors that are known global brands in energy management, and most familiar to the Australian audience are probably ABB, maybe EDP and Yokogawa as well. We're optimizing close to a gigawatt of batteries now, and we have behind the meter load portfolio of about 2.5 gigawatt. And of the more than 160 staff we have, over half of them are data scientists and software engineers. And here are a few of the industries that we're active in. You can see here, these industries range from those with highly energy intensive processes through to lower intensity energy users. But the commonality across these industries is the opportunity to reduce energy costs through diving deeper into how energy is used on site and deploying smart and dynamic energy management that understands your specific site. So in summary, I think I'm right on time. In summary, using advanced forecasting and digital twins can actively manage energy alongside your production to generate value. And this is done through a combination of operational data with energy pricing on an advanced VPP platform. You always maintain control. You have the option of setting up the platform as a co-pilot with a human in the middle, or as an automated process with override capabilities to avoid missing high value opportunities. Real-time optimization maximizes site value, and that's a real key point. You have to be operating, recognizing the volatility in the market, and our forecaster gives you that opportunity by reforecasting the next interval or the next time period every 5 minutes. And batteries are an asset that can augment process optimization on your site. So with that, I'll hand it back to Giles. Over to you, Giles.
Thank you very much, Chris. Interesting stuff. Yes, the case for businesses or dealing with the market is getting a lot more complicated due to that increased volatility and getting your mind around these different services and options to manage that. To help explain that, next guest, actually, before we go to our next guest, I just want to prompt for the first poll question, if we could probably have that up. And there, here we go, pretty simple. How does energy rank in your operational costs? Within the top 3 expenses or within the top 10 expenses. So we'll be interested to see what your response is from there. Just a reminder to people, if you do want to have a question, we've got a long Q&A period at the end of the next presentation. So please put it in the Q&A box at the end. I see at least one is in chat. That's fine. We can probably find that as well, but it's preferred if you do it in the Q&A box. Look, our next presenter is Andrew Redaway. He is the EV team leader with NHAR. He's previously worked for the Australian Energy Market Operator and for the not-for-profit sector. At NHAR, Andrew has led and leads many projects for clients, including local government and businesses, delivering detailed feasibility studies for batteries, electric vehicle infrastructure, and solar. All of these things which do best when they are managed, and probably best managed by AI. Andrew has a strong understanding of the needs of energy consumers from technical to economic considerations. And here is Andrew now to present. Welcome, Andrew. You have the floor.
Great. Thanks a lot, Giles. So I'll share my slides. Unfortunately, they're not quite as pretty as Chris's. They might be a little agricultural in comparison, but hopefully they'll get the message across. So yeah, I'll be presenting some of the things that we've identified at NHAR, like with the work we do with clients. So we're a smart energy consultancy, as Giles mentioned. So yeah, everything from feasibility studies through to owner's engineer role, through to detailed design, drafting, etc. So yeah, I'll be covering some different topics about battery benefits, and you might be wondering what these little silhouettes are. So just to add a bit of interest, I've assigned a movie action hero to each of these benefits to sort of try and illustrate the differences. Okay, so storing excess solar. I think pretty much everyone on this webinar would be familiar with this, and also probably familiar with the chart at the bottom. This is the old school way that sort of dumb batteries would work. But just one improvement I would suggest, even if you are going with a fairly simple logic, you might want to differentiate between a sunny day and a cloudy day. And because if it's a sunny day, your battery's going to get charged anyway. So you may be better off to just wait until around midday to actually charge it, because that's when you probably get the best benefit from avoiding curtailment and those sorts of things. So yeah, you probably don't need AI to achieve that one, but yeah, even simple logics can have some benefits. So for this one, I'm going to go with Clint Eastwood, old school. He can ride off into the sunset when the solar day is over. Okay, so arbitrage, time shifting. So you're charging for the grid at cheap times, and then obviously discharging when it's more advantageous for you, which you can do on like a standard energy plan contract, or if you're exposed to wholesale spot prices, spot market. So one of the things here is if you're deciding is, well, what sort of spread are you going to be able to access out into the future between the cheap and the expensive electricity? So some people use like a sophisticated forecast out into the future based on what's going to happen in the energy market and the transition to renewables and all that. In other cases, they just go, well, we'll just use a historical data to assume a Groundhog Day repeat of like 2019 for like every calendar year out into the future, or 2020 or 23. But which one do you pick? So this can make a big difference because, as Chris explained, like the volatility is pretty large, and if you just pick one year, then you're probably not getting the best business case, or the most accurate business case for installing a battery. Another point is the cost of batteries. So, you know, the capex. So we had an example recently covered on Renew Economy reporting about the battery tender in New South Wales for 8-hour batteries. So yep, that was a good benchmark that we can refer to. That was for fairly large scale batteries. And yeah, across the landscape with all this new capacity coming in from big batteries, home batteries, snowy hydro, vehicle to grid could be massive. So this is the question, like, is the storage going to get ahead of the generation, or is it going to be vice versa? And that can have a big impact on basically that duck curve in the energy and the prices in the wholesale market. And just one point here about if you are doing arbitrage or time shifting of energy using a battery, then, or even by moderating your production levels, as Chris was describing, if using a battery to import from the grid, just be a little bit careful if you are on a contract that has a demand charge. And so, as I've highlighted in this example excerpt from a bill there. So if you're on a demand charge where you're being slugged a ongoing charge based on your highest historical interval for your input from the grid, then yeah, you might have successfully earned some energy, earned some revenue on the spot market, but congratulations, you've achieved that at the cost of increasing your demand charge payments for the next month or the next year. So that's something to be careful of, and you probably need some smarts to help avoid that. Okay, so grid arbitrage, time shifting, well, that has to be the time travel action hero, the Terminator. Okay, now FCAS, frequency support. Yeah, Chris mentioned it a little bit in the slides, and not so much in like detail, but that's probably a topic for another whole webinar, I guess. So yeah, it can be a big part of the benefits that you get from batteries, and we're talking about fast response, like fast action. So that would be Bruce Lee. And a key trend in that area is the relatively new market for very fast FCAS, where you have to respond within 1 second from your battery. So yeah, in that case, I think we're talking maybe about the Matrix, dodging bullets, etc. And the chart down here is just from a particular quarter. So this is from the market authorities. Just showing that in that particular quarter, the 1 second market was a big slice of the overall revenue that was achieved by FCAS providers. So yeah, it can be quite significant. Okay, peak lopping or peak shaving is another related term. So this is where you're really going after that demand charge on your bill by reducing your maximum demand. And no, these two kids here, they're not the movie action star, just in case you were confused. I put them here because it's an example from a client we did a study for. So yeah, indoor skydiving. So this is one of their high demand days, and they have these regular sort of peaks according to their operating schedule, like which sessions they have for the skydiving. So with a profile like this, then that's quite suitable for peak lopping, because the spikes are quite skinny. You can lop them off easily without needing a massive, huge battery to do it. Not everyone's like that though. So the movie star for that would be from the movie Kill Bill. There was a lot of lopping going on in that movie. Okay, government grants. So you might not think of this as a benefit for your battery, but basically, if you can get a grant to reduce the capital expense or get some other financial reward, then that can make a big difference on your business case. So yeah, how well does your battery present, and will it do what the government wants? Like James Bond, that's what you want your battery to be in that case. Blackout backup. So if this is important for you to keep your operations running in a grid outage, then yeah, that is maybe harder to put a monetary value on this than compared to some of the others, but yeah, in some cases it's really significant. So this is going to be Sigourney Weaver. When all the life support systems are going down, who do you want on your team? Got to be her. So benefit stacking. Everyone talks about stacking the benefits. So more is better, right? The more benefits you can get from your battery, the better. Well, yes, but you have to be smart about it. You need some clever systems, and I'm sure yeah, AI would definitely be part of that. To try to make sure that your different benefits are playing nicely together and cooperating. So for example, if you're reserving a whole bunch of your battery capacity for blackouts, then that's working against using that capacity for your other benefits. So perhaps you can use strategies like storm watch, storm mode, where you're only reserving that battery capacity for the blackout if you have a forecast of a heat wave, bushfire, etc., etc. Another one is using your battery capacity for arbitrage on the wholesale market versus FCAS. So basically two different markets that you could be bidding into. And so, yes, obviously the smart systems, dynamic systems are going to be the way to go there. All right, so the conclusion. So how do you get the most out of the battery? Well, you really want to do some work up front. You want to study what you're doing, make sure you're going to get no surprises through the whole project. And as part of that would be like simulating and digital twinning, etc. And stacking up the technology specs, engineering, who are the project partners involved, and yeah, smart battery optimization. And that's it. Thank you.
Thank you very much, Andrew. Interesting stuff. Love all the references to the movie stars and things. So keep it relatable. Look, we're going to go into Q&A, and I'm going to introduce our next guest as well. First of all, we had the first poll. Sam, can we have the results of that first poll? There you go. That's interesting. Sort of energy ranking, operational costs, 40% say it's within the top 3, 60% say it is within the top 10. So it's interesting. Can we put up the second poll, please? Here we go. Fixed or spot, are you on a standard energy contract or exposed to the energy spot price? Standard energy contract, spot, or not sure? Hopefully some of you know, or maybe some of you are about to find out. Look, we do have another guest I'd like to welcome now. William, just trying to find the reference here. William Salas. Welcome, William. You're from GridBeyond. Describe yourself as a self-proclaimed engineer, an obsessive problem solver trying to do his bit to accelerate the energy transition. And William has extensive experience in the battery energy storage market and the national electricity market. William, thanks for joining us. I think my first question's actually for you. And just a reminder to everyone, if you do have a question, please put it in the Q&A box. We can probably find them if they're in the chat box, but we'd probably prefer to have them in the Q&A. William, the first question for you, and I've just got it here. Where is it now? I had it right in front of me and it's gone. Just how do you tell whether a battery is going to give a return on investment if you're a small business?
That's a good question. And I guess imperative that it's answered accurately. So I've worked on, batteries, solar, energy efficiency, and they all require a business case. So batteries no different. You need to do some sort of cost benefit analysis to understand whether the opportunity stacks up. And the trick with batteries is, as I think both Andrew and Chris spoke about, is they can do a lot of things. People describe them as the Swiss Army knife. That's true, but because of that and the fact that they're a net consumer of electricity, they don't produce power like a solar or let's say a wind farm, but behind the meter solar system. They can do any number of things, and that requires considerable understanding of their technical requirements and financial, and we need to do that through some sort of modeling exercise. So just like you would do the sort of business case for any opportunity, it needs to go into some sort of techno-economic modeling platform. GridBeyond has something like that. We call it Designer. There's many out there, and that will allow you to come up with whether it is suitable. And that is looking at things like your tariff from the network. Maybe that is different to how your retailer charges you. It is looking at the technical requirements at the site, like what's your maximum import and export limit. If you don't already have solar, are you looking at getting solar? Are you looking at upgrading the network so you can consume more power for increased plant facilities? So modeling is the answer, and it'll be interesting to see how the industry evolves, because solar, I would say, having built some of these models, is a bit simpler compared to the battery piece.
Mm. Andrew, just a question back to you. The federal government is announced in the election campaign a rebate for household batteries. But it's not just household batteries; it's also sort of smaller batteries for the C&I space. So, how should people be thinking about that? I guess it's sort of a linked to the answer that William just gave.
Yeah, that's right. The rebate from what's been announced will you can get a rebate on battery installations up to 100 kilowatt hours, but you only get the rebate on the first 50 kilowatt hours of the battery capacity. So yeah, for some operators that's that's insignificant, like a battery that small, but for other businesses, yeah, that could be pretty useful, especially if you have a business with sort of multiple smaller sites rather than one massive plant. So yeah, you could get all sorts of benefits from a battery. You'd probably, if you're playing on the FCAS market, for example, you need to go through aggregators. But yeah, you could get all sorts of benefits from blackout backup or peak lopping for demand charges. Yeah, participate in VPPs, as in like the multi-site kind of VPP. So yeah.
And Andrew, there's actually a question from someone here about what exactly are demand charges. What does higher demand charges mean? I mean, I guess that's just asking for clarification on those demand charges. But so a lot of small businesses and even some other customers don't get charged by the amount of electricity they use. They get charged by the maximum they use and pay accordingly to that. Can you probably explain it better than me?
Yeah, so fairly common in for larger energy consumers out there. Not so much for households, although there has been cases where households have been unexpectedly put onto these sorts of tariffs. So demand tariff. So that's where your electricity plan. It probably would have a component in it, which is like a fixed charge and an energy charge. But as well as that, you have a component which is a demand charge, a demand tariff. And so what that means is your retailer is going to look back over your last month or your last year and say, well, what was the highest power that you were importing from the grid, like in a half-hour interval over that time period, and then use that number and multiply it by a factor, a tariff, to come up with what's your charge on this bill. So it's a dollar amount, and it's related to the intensity of your draw from the grid historically.
Yeah, which is one good reason actually to have a battery, because you can actually use the battery then to sort of clip those peaks and then just lower the overall demand charges then, and manage that with smart software or AI, I guess. Chris, this is one for you maybe. Can you apply the GridBeyond approach for EV charging and discharging if car spaces are wired up and vehicles plugged in? I'm not too sure if that's a question for you, Chris, or maybe it's one for Andrew, but Chris, do you want to have a go at it?
I think you're on mute.
Hi, Chris, if you're on mute.
Yeah, sorry, guys. We see our platform being used for large commercial style EV charging, like for example, bus depots. Bus depots are becoming more and more electrified as they transition to the electric vehicle as their predominant mode. And they're a great one for batteries as well, because typically what they have is the vehicles coming back in the evening after they've done their rounds, and their peak demand is during the evening. So during the day, there's essentially very low load, and evening very high load. It's opportunistic to drop a battery into those sites so that you're capturing energy at a very low cost during the day, and pushing it into the vehicles in the evening. It can be also, when you distill it back to a consumer or residential type application, you can be thinking about it in terms of an aggregated platform play. But realistically, you need scale to really see the benefits of this type of platform and in operation.
Okay. William, here's a question back for you. Actually, why don't we publish first of all the results of the second quiz or poll? Sorry. There we go. Most people are on a standard energy contract. 17 exposed to spot and 13% not sure, which is interesting enough. So that's interesting. I'm not too sure what to make of that, William or Andrew, or Chris. But Chris, in fact, why don't we just use that opportunity now to put the third poll up and see what people have to say about it. William, here's a question for you. This poll, sorry, energy consumption. Do you actively control energy consumption to reduce production costs? Yes or no? Pretty simple answer. Here's a question from Tom, William. The NEM is changing so fast. Are you sure you have enough training data? Most machine learning and statistical approaches will perform poorly on out-of-sample events, such as line outages that haven't happened in the last few years, or coal plants shutting down, etc. In these cases, you might be better with more traditional physical electrical modelling. How do your AI price forecasts handle the more significant but previously unseen events? And that question was reported by a couple of other people as being a good one. William, are you best placed to answer that one, or is that one for Chris?
I'll certainly.
Yeah. Why don't Will, I'll tee it up for you, and you can go a bit deeper, all right?
Yeah, sure.
So when we think about the AI side of it, right, just to be clear on how that AI is coming up with recommendations, right? So it's got a number of inputs. Its inputs will be market data, so real time and day ahead, regional data, historic market clearing prices, regional price separation patterns between different states. There's also system configurations, so the demand at any given point in the NEM, whether there's a generated trip, so that goes into event type forecasting, generated rebidding behavior, because we know that quite often we see that from some very active bidders. Outages, wind and solar forecasts, net load calculations, historical congestion. So these are all inputs into every 5-minute interval data. And, it goes further into weather data. So, what's happening in terms of temperature and forecasts around the major load centers, what's the wind speed, the irradiance, storm tracking, and it looks back on any historical weather patterns and correlates what's happened in energy markets at that time. So that's, what we talk about in terms of AI is taking in a whole pile of inputs and connecting patterns, and then coming up with recommendations. So, Will, did I summarize that well enough?
Yeah, I think that's like a nice overarching view of AI, and I think that'll speak well to a lot of the audience. The question indicates that we've got some very cluey people, which is great. I love that. That's I identify, as Giles said in the intro, as an energy nerd. The challenges, I think, I forget who asked the question. Apologies, was it Tom? The challenges you're speaking about are, yes, we can't forecast lightning tripping an interconnector. We can certainly anticipate that it may occur, but at what second in the day is very impossible, and that's because that's the nature of contingency services, which is part of what you're talking about. And general energy volatility, I like to separate it out into stuff that we can forecast and then the stuff that we can't. And all of that's baked into our models, but certainly we're not going to ever be able to predict the type of events that you're talking about with real accuracy, but we are certainly improving upon what is available in the market today. We're currently about to release a little PR piece on our accuracy, and I think that will help you sort of understand where we sit in terms of our forecasting. So yeah, watch this space in terms of that, but at the same time, fully acknowledge that we're not at that point where we're forecasting weather events down to the second.
Okay. William, staying with you, and can you elaborate how you are leveraging digital twins for the optimization of costs?
Yeah, great question. So just to reiterate for the benefit of anyone who sort of joined late, basically a digital twin is a mathematical model that is replicating a facility. In this case, it's an industrial facility. So let's take an obvious for us, a cement site. And what we would do is mathematically model each component of that site. So you have conveyor belts, crushers, all these different components. Some of it is flexible, some of it is not. What we will be doing is forecasting both price and how that site should operate in terms of consuming power relative to the cost of power. So that's how we're using it currently in the world of digital twins, and the same concept is applied for a battery. So we also, in part of our optimization package, are using a digital twin to make sure that the real asset, the one that exists in the real world, is performing, but also ideally going to operate how we plan, because we are modeling it in real time. It sounds all very meta, but essentially you can think about it as quite a sophisticated mathematical model that allows us to make better decisions on what the site should do next. And that can be applied to batteries as well.
Okay. Another question here. I'm not too sure whether it's going to be a Chris or Andrew one, but put your hand up and hop in. How frequently can you change your battery strategy to suit known usage increases or decreases?
Yeah, I'll have a go. I'll have a go. So, however often you want, right? The constraints or the requirements can be downloaded from the cloud. There's a nice dashboard that you will get that you'll be able to update any of your parameters. So it's you can do it as often as you like, really. But we can also help you to try and optimize, right? So the concept is that it's not just about changing the parameters, it's about trying to get the maximum value. And we would work with people around that optimization.
Okay. There's another question here about how should industry go about selecting a VPP partner, a virtual power plant partner? What are the distinctive differences between VPPs? Anybody want to put their hand up for that one?
It might be a Will one.
Will.
Apologies, I was reading some of the other ones. Who was it from?
It's from Mark Pickering.
Where is your question?
It's in the Q&A one. There's an
Yes.
awful lot of chat going on, which is great.
Yeah, I know.
It's okay.
I'm trying to juggle
You've been
the
distracted
two.
by that.
Yeah, I want to get involved in the chat.
Yeah.
There were some good questions in there that I'd like to answer too, but let me try and
feel free, because we probably won't get to them all, but we'll try anyway.
Yeah. And obviously, anyone, if you want to know about us, I'm happy to talk about this here, but also at the pub and also during work hours if it's relevant. So feel free to reach out. How should you go about selecting a VP partner? What is the distinctive difference? So we should say, like, GridBeyond specializes in C&I VPPs when we're not currently focused on residential. So they're very different, conceptually doing the same thing. Different because the type of assets that we're controlling are, orders of magnitude different. I'm part of one at home, and I am constrained by the network where I live. So not every VPP will service every region within the country. Then also you need to work out what's of value to you. So some VPPs will have tech around certain assets. Everyone would like to do everything, but often what you'll find is someone like GridBeyond, we're really good at trading and optimizing batteries. And obviously that's something that requires that, and there will be some limitations. So I won't say names, but I know in the resi space, there are some VPPs who just don't work with all the OEMs. They just don't currently have every OEM mapped out. At a C&I scale, you typically don't have that issue because what we're doing is a bit more work to interface with the on-site assets. So when we say on-site assets, this could be load, and that's a PLC or SCADA system for very large sites, or it could be the on-site generation, which should be more straightforward because it's a recently installed piece of equipment and generally is in a bit sort of easier to interface with our product. So depends on your needs, what assets have you got, what value streams. It's not a simple answer.
Okay. We might just go to see what the results of the last poll are. If Sam, if you can post those. Energy consumption. Do you actively control energy consumption to reduce production costs? Yes, 54%. No, 46%. There you go. There's a market opportunity, guys. So 46% of the people responders anyway. So that's interesting. Chris, is that typical?
It's really hard to say whether it's typical or not, because I'm not sure of the cross section of our audience, but I would imagine that larger commercial and industrial plant owners or operators will be actively managing. Almost all of them will be actively managing. The question is whether they're actively managing it to a point where they're getting the most value out of it.
Right. Yeah.
Because I think rudimentary control in the past has been, okay, I need to modulate down in peak price periods of the day, or when I expect there's a peak price event through some sort of notification process.
Yeah.
And quite often that is post it occurring.
It used to be very rudimentary. I remember running control rooms for demand and response programs and calling people to get in their ute and drive down to the pump shed and start curtailing load. We've come a long way since then, although some people may still be running on that sort of approach. But in the ideal world, we have this fairly automated, so we don't have interruption to operators so that they can get on with whatever it is. Because at the end of the day, whilst we want to flex the flexible component of a site when we're talking about load as much as possible, we also want to have the least impact on the site. and especially on operators who at the end of the day aren't there to be making money through energy markets. Their core business will be something unrelated. And so that's where someone like us steps in and tries to optimize that in terms of doing it an amount that makes financial sense, but impacts their business the least amount in terms of allowing them to get on with what they do.
I'm going to have to go back to the very start of our Q&A. Bradford Sherman asked a whole bunch of different questions. I'm going to feel really bad if I don't actually ask some of his. His first one was about the bidding practices. He talked about battery developers and Neoen in particular. And I'm thinking this probably refers to an article I wrote a week ago about those high-priced events, which the energy regulator is obliged to sort of report on and explain how they happened. And it's just basically a whole bunch of bidding price strategies or events which happen, like, you know, transmission lines gone down, coal plants going off, or some other things. He does ask a question here about what is meant by this change, the change of charge state used to justify the changed bid. Look, I don't know whether Chris or Andrew or even William have any insight into that. My understanding is that there is no real explanation. It could be related to their obligations on FCAS or other parts of the markets. One of the problems is that there's so little visibility around these issues and these sort of and these things. And this is something that was actually raised by Tim Nelson, who's leading the review of markets for the federal government. And it's just talking about, you know, we've dealt with weather dependency, weather-dependent grid for decades now, really. But what we do lack at the moment is visibility. And he's quite determined to develop a market system that actually sort of allows that visibility into the market, because we don't actually know exactly what happens behind the scenes. Bradford has another interesting question. Has either speaker, or has any of the speakers been surprised by an insight provided by AI that they had not previously contemplated? William, Andrew?
I can add a bit of color to the first part. I've spent a lot of time reviewing the regulators' best bidding, or they've issued a number of bulletins over the years on bidding practices. It's definitely worth your time reading those. They're actually quite concise and brief if you're genuinely interested in understanding this and what is allowed and why it is fairly grey, because it's written in these formats in fairly non-binary language. So you are allowed to rebid. That's part of the design. There are restrictions as to when you can do that, but it is quite late, and the definitions around why you're allowed to bid, I think, for better or worse, quite generous. And so I think this is what it comes down to, is how that best bidding practices are, what bidding practices are defined. So reach out either to me or just Google search bidding practice AI, and you'll get up to speed on that.
Right. Okay. I've got a question from. Oh no, go ahead.
Oh yeah, just wanted to introduce a bit of a longer term thought, a related thought on that, which is moving towards a like almost totally renewable grid. If we're going to need energy storage to get through like the bad weeks of like when the sun don't blow and the wind don't shine and all that, then there's going to need to be some pretty tightly coordinated management of all the batteries. So you might want to be discharging your longer duration storage like earlier in the week and holding back in reserve some of your shorter duration storage so that you can meet the peaks towards the end of that like week-long event. And so in terms of the market rules and things, I think that's, I mean, some of these shorter term things seem like easier to fix rather than how do you get these all these players to, you know, cooperate with each other when they're used to like rebidding and all that to maximize their short term profits.
We're getting towards the end of the end of the thing. We've probably got about another 5 minutes. Maybe we can stretch it to 10. So if there are some open Q&A, and there are 25 actually, so I'd invite the panelists, if they're not talking on the thing to maybe hop in and give a typed answer. Someone's asked about, can batteries and energy management help bakeries decarbonise and reduce costs? Is there a case study owners can look at? Look, I guess the question is not just about bakeries, although I suspect that Dean, who asked the question, has a bakery and wants to know, or is an investor in one. But I guess it's a question also for small businesses of all types. Anyone want to have a think about that one?
Yeah, I think one of the first things we do is look at the load profile, just to understand when the energy is being used. We look at the contracts, and we come up with a view on whether storage behind the meter may provide one of the benefits that Andrew's gone through. So I think the potential is yes. It depends on your current retail bill structure and really time of use. Now, I'm guessing with a bakery, you're going to be baking a lot at 4 or 5 a.m. So a lot of your energy consumption is going to be early morning, probably off peak. So the economic argument might be a bit harder to come up with to support that investment, but you never know until you actually look at the data.
Okay. Another question here about God, I had it here just here. Where is it? Where's it gone? Yes, another one for you, Chris. You just mentioned day ahead prices. We don't have those in Australia, says Tim. Do we need them? Because at the moment, AEMO's forecasts are, he says, appallingly inaccurate.
Yeah, so we don't even really think about day ahead pricing. Like everything is forecast for the next so many intervals. Like we forecast out a week in 5-minute intervals, based on all those inputs, plus more that I mentioned earlier. So really, if you think about the genesis of our company, it's come from demand response. And demand response is very instantaneous reaction to what's occurring in the market. Our forecaster, as I said, is, you can put whatever term on it, day ahead, week ahead. We're providing a 7-day forecast in 5-minute intervals.
Okay. Right. David asks, how does GridBeyond charge for their services with software and consulting? Is it a share or benefit or another model? I asked that one because it's the perfect advertising pitch for you.
Yeah, so it's we're flexible. Obviously, there's some setup charges usually, and then it's a percentage of revenue or a fixed fee. But really, we want to give you confidence that we've got skin in the game. If you're not benefiting, we're not benefiting. So we're happy to go a percentage of savings or a percentage of value.
That's interesting. Richard asks an interesting question. The benefits are presented with respect to benefits for enterprise and customers. In reverse, will substantial adoption of these systems actually reduce volatility?
Yeah, eventually. But if you think about the scale of this grid transition that we've got and the timing of the coal retirements, we've still got many, many years of volatility ahead of us. And Will, you're going to be better to comment on that.
Yeah, I think, like, to me, let's go back to basics. If you think about the traditional power system in terms of thermal generation, providing power when we need it, as in industry, consume everybody, and we paid no regard to when it's being produced or what we're doing. And now we're moving to a distributed system where we've got renewable generation that's going to be the most common form of generation. And that's not a function of when we do things, it's a function of when it the wind is out and the sun's out and it's windy. And so the more people we have being flexible will better allow us to match supply and demand, and you'll end up with a better price outcome. So as Chris said, is that we're sort of really at the early stages. We've been doing very basic, I'd say, dumb DR and behind the meter stuff for like 20 years. There are very sophisticated clients out there doing what they could with the technology available at the time. But we're now moving into the sort of next generation where we can be a lot more flexible. And so I dare say a lot will be untapped that hasn't been, that, a lot of academics have sort of been modeling that, if we got to 30% flexible across the whole demand side, we'd sort of solve a lot of these problems, but I just don't think we've had the tech. So I think we're moving into that space, and I think it'll absolutely benefit all consumers if we have more flexibility during the times we need it, which is high pricing. And whether that's behind the meter batteries, that's plugging your car into the grid, whatever the flexing or resources are, that'll all contribute to it and push that peak period, or now we'll probably get two peaks, the morning peak, which we're seeing, in the evening peak, and everyone will experience better prices.
Look, we've got so many questions here. We're not going to get to them all, but I'm going to extend for another minute or so because there's another question I thought would be good to answer. It's from Charles, who's asking about, it's all pointing to being able to handle even more generation of rooftop renewables where the excess can be used for large commercial projects. What is the amount that is generated on a rooftop that determines the term VPP being used? If we can generate more on rooftops, more assistance can be accessed to, more can be done with excess. And there's actually sort of like a related question about that, but at what stage, from Peter, at what stage of the system design process for new PV and battery systems do you need to decide if VPP is a strategy or not? Andrew, is that an opportunity for you? Or?
Yeah, I can speak to that one. So what the approach that we normally take with our clients is, if they're in the very early stages of trying to identify the business case or the scope of whether it's worth it. At the early stages, we don't really jump into a VPP or non-VPP. It's more about, okay, what are the economic savings? What are the benefits that can be obtained, and then how that can be obtained is more about slicing the pie. Are you going to incur capital cost yourself and take on market risk yourself, or effectively are you going to outsource some of that via a VPP? That's talking the multiplayer kind of commercial VPP that most people would the term most people would use.
Yeah, okay. Guys, we're probably going to have to wrap up this webinar now. Look, we've actually got 27 questions still unanswered, and there's a whole bunch on chat as well. Look, I really do appreciate the feedback from anyone. And look, clearly this is a subject which a lot of people find really, really interesting. And I invite you all to sort of reach out to Chris and Andrew and William. I'm sure you can find them on LinkedIn or on the internet or the emails. There's going to be a recording of this podcast, or this webinar, sorry, available. And guys, are you okay to release your slides? And there's been a couple of questions about those.
I'll send them through to you, Giles, and you can circulate them.
Fantastic. We'll put them up on our website. We usually have a recording and the slides available. So look, once again, thank you to GridBeyond for sponsoring this webinar. Really appreciate it. Really appreciate Chris and Andrew for your presentations. Fantastic to have you on there, William, as well, with your contributions at the end there. And thanks for everyone for joining and participating. And we will hope we'll have another webinar sometime soon. That's all for now. Goodbye.
Thank you.
Thank you.